The third quarter tends to be a period of strong demand in Chicago's apartment market. That certainly was the case in the July through September 2015 timeframe. We'll explore Chicago's very solid apartment sector performance in today's edition of Apartment Market Dynamics from MPF Research. I'm Greg Willett, joined today by Cameron McIntosh. Cameron, really strong demand numbers in Chicago for third quarter. Tell us about those.
Absolutely, Greg. Net demand across Chicago's metro came in at a robust 4,050 units for third quarter 2015. That compares to roughly 3,600 units demanded in third quarter 2014. Now, what's important here is that annual demand in Chicago was at a robust 8,778 units. That demand in Chicago outpaces supply that totaled 5,280 units, Greg.
So demand ahead of supply, that's a story we like to hear. It means occupancy is headed upward. What are the specifics there?
Absolutely. Well, occupancy stood at 96.5% in third quarter 2015. That's more than 60 basis points up over the year. Now, what's really important is that that's the highest occupancy we've seen since the fall of 2007. That's more than 170 basis points, Greg, over the long-term average of 94.8%, which was established over the past couple of decades. But Greg, as we dig into these numbers, what's really impressive is that occupancy has remained strong across Class A, Class B, and Class C properties, indicating that the market is essentially full. Likewise, occupancy has been impressive in the urban core submarkets, as well as in the high-priced and the less desirable suburban submarkets.
Good demand, good occupancy, that's usually a recipe for very solid rent growth. We do see, in fact, solid rent growth, but not spectacular rent growth in Chicago's apartment market. Looking at third quarter specifically, the effective rents for new leases climbed 0.8%, and that took annual growth to 3.8%. Now, rent growth of 3.8% is, in fact, the best that Chicago's done in about 3 years, and it's a hefty premium over typical pricing power that recorded over the long term, but viewed in the context of what's happening across the U.S. with growth on rents well above 5%, a number that's just a hair below 4%, isn't really all that impressive. As we dig into some of the product niche stats, we see that the highest rent growth is in the Class B product. Their pricing is up 4.5%. As we dig into the influences on these rent growth numbers, I think a factor that's coming into play is some weak income growth. And in fact, if you look at the latest numbers from the Bureau of Labor Statistics, they're showing that Chicago has actually had some wage loss over the course of the past year. So it is a metro that's gaining jobs, but jobs seem to be not of the caliber and overall quality that we see across a lot of metros.
That's absolutely right, Greg. But how does renewal lease pricing compare in Chicago to the rates paid by new residents?
The pattern here is a little bit different than what we see across most metros in the country, in that it's typical for the rates for new resident leases to be going up a little bit faster than the renewal rates. We actually see the exact opposite in Chicago. So renewal prices jumped an even 5% in third quarter, and Chicago is a place where you tend to have relatively high renter retention of folks who had leases that were expiring in third quarter. 53.3% of them chose to stay in place and renew their lease.
Turning to near-term delivery information, properties now under construction in Chicago total 11,259 units. Those additional units will expand Chicago's inventory by 1.6% over the near term. Ongoing construction remains in line with the activity that we've seen over the last 2 or 3 years, Greg. But what's important is that a majority of this construction is concentrated in the Loop and the Streeterville River North submarkets, which comprise the urban core. But what's important, Greg, is that almost every submarket in Chicago now shows signs of delivering some upcoming supply. That's a theme that's emerged over the last 2 or so quarters.
As we look ahead, we think that the performance in Chicago is going to be very solid. Occupancy could come down a little bit from where it is, but where it is right now is really, really strong. Solid rent growth also appears likely to occur here, with pricing going up 3.5% to 4% annually over the next couple of years. That wraps up our look at Chicago's apartment market. For Cameron McIntosh, I'm Greg Willett. Thanks for joining us for Apartment Market Dynamics from NPF Research.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.